Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have Rob Chase, the chairman of MediaValet, to give us an update on the company. MediaValet trades on the TSX Venture Exchange under the symbol MVP and in the US under VRXWF. The company is trading at $2.62 with roughly 38 million shares outstanding, or about $100 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks, Trevor. Rob Chase, good to have you back. It's been a little while. As a matter of fact, last time we spoke, I just checked, it was in May of 2020. We were just smack in the start of the pandemic. It's great to have you back. I know lots happened to the company since we last spoke. So why don't we start off by giving a brief summary of what MediaValet does, and then we can catch up a little bit.
Sounds great. Okay, here, I think I can share my screen now. So let's just have a little backdrop here for us as well. Let's see if I can, there we go. Yeah, wonderful. Thank you for that, Paul and Trevor, appreciate it. So I'll try and be fairly quick on kind of just the background here. So MediaValet, again, emerging a leader in enterprise class digital asset management. And digital asset management is really providing a single source of the truth for all the digital content that organizations create, and enabling people to share it, search it, find it, secure it, make it triple redundant around the world, and really enable them to plug it into their entire marketing stack. And ultimately, if you're going to be a successful organization in today's digital world, you need a sound digital strategy, for all your content, marketing, and advertising. And to get that right, you really need a DAM to look after all the assets you're creating and make sure they're at the right places at the right time, and your branding stays consistent. So, that's really the thread through which MediaValet is being pulled. In any event, 100% cloud and SaaS as well. Over 300 customers now. Our 5-year CAGR is 55%. We are working hard to execute on the strategies to go and try and continue that into the future. Great customer experience, net retention rates of 100%. Approximately, specifically 2020 was 97%, and 2019 was 100. So you had your bit of a COVID impact there. We've been at it for over 10 years developing the technologies. There's lots has gone into this. It's been very customer focused, very purpose built. And really what we're trying to do is we're trying to provide an enterprise class experience without the complexities of traditional enterprise. And you might hear us talk sometimes maybe at the enterprise use case. We're truly solving for the enterprise use case, but we're not making you go through all the complexities of the traditional on-prem, large, enterprise providers who also, apply the same model when they go cloud. That is, it's still a very complex, heavy lifting a solution set when it's traditional enterprise. And we've done away with that to make enterprise capability accessible to customers of all sizes. And consequently, our customer range goes from $6,000 US a year up to $508,000 US a year. So we've got a pretty broad spectrum of customers we can support, from SMB if we need to, all the way to full global 1,000 Fortune 1,000 companies. So great year for us as well from a balance sheet perspective. We were lucky enough to be offered a bought deal in October. We now have $16 million of working capital at the end of December, $14 million in cash. We've raised about $42 million to date that's gone into building out the offering and the robustness of the system. Headquartered in Vancouver, over 60 employees, leaning in heavily on R&D right now to go and expand the team, to go and tackle the opportunity ahead of us and make sure that we unlock the value the potential that's there with the capital that we have. So that's just a high level overview of us and kind of what we've been up to. But is that good for just an introduction, give people a flavor for what we do? And
yeah, I think it does. I mean, certainly later, if anybody's got any questions, they can use the chat function, and we can follow up with anything that we may have missed. But why don't we just dive into it? You guys actually had a pretty strong year. Clearly by the chart there, things continue to go in the right direction. But why don't we talk about the year as a whole? Well, let's start with COVID. Like we've now been into COVID for about a year. What do you see that doing to your business, both from an operational standpoint and has it presented new opportunities for you?
Wonderful. Yeah, it's a great question. So let's, again, I think there is, when we talk COVID, and I'm sure it's like this for most businesses, it's a tale of two stories, right? So the short-term COVID impacts versus the long-term trends that are coming out of it. And, what we saw going into COVID was that DAM was becoming more and more a must-have, right? That was already happening. So this slide here really talks why digital asset management, but again, connecting global advertising, which is now predominantly digital, all the way down to how do you make sure you got the right assets in the right place and looked after properly and things. And that's what DAM does, right? As part of that entire experience. But, that trend to the cloud, that trend to digital strategies, that was happening. So 85% of our business in 2019 of our new customers was all greenfield, right? And that continues to be that way today. We just signed up the Greater Toronto Airport Authority in December of 2020, and 20 terabytes of wonderful GTA branding and media and advertising. Think about all the posters on the gangplanks and things in the up, and then plus in the cloud, etc. Like in their, all of their social sites and partner sites and things. Where their assets have to go and how many there are is just mind-boggling. And they were managing that with, on SharePoint, Dropbox, and local servers. Just, I don't even know how they do that. It must have had an army of people just looking after that piece. So there's a greenfield example of quite a mature client who's tried to make do without. In any event, that's been the trend that's been happening. Organizations grow, they realize that digital is important, they need to get going, they want to go cloud, they want to go SaaS. So all those trends are continuing. When COVID actually hit, two things and let's talk the tail of the short term. Two things happened. One is customers who were in the buying process or are thinking about DAM, wanting to get going buying, hit the pause button, right? As we know. So that made, for us, what that translated to in the year was our CAC ratio went from 81 cents to generate $1 of new business in 2019 to $1.25 for 2020. Not too bad, but in Q1 it went to over $1.50, and by Q4 we got it back down to $1.15. All right, so what we saw from an acquisition perspective is the sales cycle got longer. Customers were struggling to move ahead with projects. They were going on hold. Consequently, Q1 last year, probably our worst acquisition quarter in over 2 years. Okay. That improved every single quarter throughout the year to the point where in Q4 2020, our net additions to annual recurring revenue was actually up over Q4 of the prior year. It's the first quarter where we were actually up year on year for net additions. So, good to see a continuing uptick or improving in our acquisition. One more thing on that from a short-term perspective, what I find interesting and tying into the market a little bit and kind of what Gartner's saying as well about DAM becoming must-have. Again, this text touches a bit to the long term. Inside that business, what actually happened was our customers with over $100,000 deal activity was up 44% over 2019. So we had a banner year. 2019 was already a banner year for us. We had a banner year for large business, which tells me that the organizations who have the larger need in digital asset management really moving forward, have been solid enough in the time of COVID to move ahead with their digital strategies, have indicated DAM is a must-have piece of that because they got going during COVID. At the same time, you have Gartner saying and Forrester saying DAM is must-have, and even more so now. And so that, I think, will bode well for us for the customer segments under those large organizations that struggled to move ahead in 2020. At some point, they start to move ahead on their digital strategies and they start to look at, well, what are the big guys doing? What is the Gartners and Forresters saying? And, DAM really, I think that's early indications that DAM's going to continue its must-have trend coming out of COVID. The other specific piece now, going back, and so we threaded from the specific to the longer term there with saying ultimately must have coming out of this COVID experience. When we go to existing customers, Q1 last year, 2020 wasn't impacted by COVID from a renewals perspective. We'd already renewed all our customers by the time the pandemic shutdown started. And in fact, we'd also expanded one of our larger customers by $190,000 Canadian. So we had a massive expansion quarter Q1 last year. Q2, now we started to get the churn happening. So customers that were struggling, just like those customers that maybe the smaller ones that struggled to make the buy decision in 2020, those types of customers, or even ones that maybe were less stayed, we started to lose some of those customers in 2020. So we had elevated churn starting in Q2, which resulted in net churn of net retention of 97% in fiscal 2020 versus 100% in the year before. And obviously we entered the year expecting 100, right? So that was kind of the impact on existing customers. Q1 2021 is the final quarter of that cycle, right? So this will capture now the tourism and travel type customers that didn't churn in 2020 because they were renewed in Q1. We'll have some of those filter out now, and should be our final quarter of elevated churn through that cycle. And now I think we should end up going into Q2 with a much stronger existing customer base and better able to go and expand those existing customers, which we've been really focused on in the year as well, building out the system so that we have not only a customer success team that we added in 2020 now, but as you can see from the screen here, a lot of our customers are coming in at the core DAM phase, and we have packages of varies in size on bandwidth and library size, and also features and things as the customer gets larger. But also there's lots of add-on modules and integrations that we've been busy building out and working upon, so that we're set up to go and start expanding customers more than we have in the past. And now that we have a customer success team in place, which we would have talked about just adding in last May when we were discussing then. But last year we added 7% expansion to our existing customer base in 2020. And interestingly, it expanded 7% in 2019 as well of our opening ARR balance. So before, that's kind of, I look at that as our before customer success experience. Hopefully with all the modules and add-ons we have here to integrate this offering into the customer's environment and therefore make it stickier and more impactful for them. We now have the customer success team that can go and ask for that business and earn the right for it, to go on and maybe beat that 7% annual, net expansion that we've seen.
I can jump back to that in a second, but back to COVID a little bit. Operationally, have you changed any? Now we're trying a lot of companies that they've found that the whole idea of working from home frees up a whole bunch of other resources. They're downsizing in terms of their lease space. And anything operationally that's changed for your business?
Great question. I mean, obviously the day it hit, we went remote, and part of the nice thing, we built our system on Microsoft Platform as a Service, and we also, which means that we actually develop right in the cloud. So there wasn't anything to move. It's just, hey, go work from home, take your laptop, off you go, or use your desktop at home. And so we transitioned extremely easily and seamlessly, so didn't miss a beat. And in fact, what we saw from a customer perspective was an increase in our utilization rates. So as they went home, they relied more on the cloud. And so we saw our usage stats going up, some cases 50% or more. So again, just pointing to the criticality of the system. That translated a bit into our gross margins as well, obviously, because they're using it more, so we have more costs. But it's not I think it's a net positive from that perspective, but because they're using it more and getting stickier. But in any event, back to us, we're still working from home, as you see, and we're leveraging Zoom to have team building exercises. We actually, David and his wife Carrie, who also works in the business, they go for walks every Friday with the team, invite them all, and they go walk through, the North Shore or whatever. So, it's still connectivity, but everybody just, did their daily meetings and kickoffs on Zoom, and off we went. So operationally, it's been good. The savings that could come from that, we haven't let any of our space go. Our thinking at this point is probably to use it as a hoteling space, because we do still want to have some interaction. But what it should mean, and I guess we think about what we're doing this year, right, is we are leaning in, right, more engineering, more sales and marketing, more customer success. If I could snap my fingers, we'd double the size of our team this year. And we'll be able to do that without increasing our leasing costs. So that's really, it's a forward savings, not a backward savings.
Yeah, that makes sense completely. You touched a little bit on at least one new contract win. But we talk about the sort of significant contract wins and maybe some names of organizations you're now working with that you landed over the last year?
Yeah, absolutely. And I'm just going to have, I'm going the wrong way. It's going to have a little backdrop here too, because, this slide I think is important. It just kind of talks to our investment in the business, the gray bar being how much we're spending, right? So we did a step increase in 2020 in the business, right? And, we had exited the year here. This is our run rate business, which is basically taking our opening ARR, or our closing ARR in this case, plus whatever we grew billings by over the prior period's ARR. So add those two together, you get your run rate, because that's basically what your sales team is doing and what your existing customer base is doing, right? So what happened in this year? Well, in 2020, of course, instead of retaining 100% of our ARR here, we retained 97%. And then instead of our sales team being able to acquire at the same level as they did, right, 81 cents per dollar acquired, we're doing $1.25 per dollar acquired, right? So the sales team has lower productivity. So we didn't attain the run rate. But this year, the run rate is much lower, right, relative to where ARR is. So, and still, even with that, we left the year in a cash positive situation, right, in both years. So got to cash positive run rate. Now we can invest. The business, the companies and the wins that helped get us there. I'm going to go back up here a bit, just as a little backdrop. Again, go to market, right? Nothing's changed here. It's, although we did hire a VP of marketing, so a lot of A/B testing going on. We're tweaking the model, but really it's a direct business model predominantly. 90% of our sales came through all the direct marketing lead generation that we did. Okay, those leads come into our business development team. They nurture those. Then when the deal is a qualified opportunity, that passes to the sales team, who then go and close and win those deals, hopefully. And now you have a new customer. Then you apply customer, bring them on board, get them optimizing, apply customer success to train and optimize and grow the customer to hopefully increase on the other end here. So that's pretty simple, right? Pretty simple model that we're up to. It hasn't changed. It works great in the remote world. And right from Vancouver through this model, we've added some excellent customers. We already mentioned GTAA in December that was announced. In September, we announced Sapem. They're a large oil and gas services company, manufacturing, consulting, et cetera, out of Northern Italy. That contract was on the desk of the CEO for signing in March 2020. Northern Italy was not signing contracts in March 2020. September, they actually signed September 30, and no changes to the contract other than the start date. It's about a $70,000 or so dollar account. We had Funimation and Crunchyroll added in the year, which are anime companies. They're now owned by the same parent. Previously, they were not. Sapem was actually greenfield, okay, new business. Funimation was actually replacing Webdam, who was bought by Binder, one of our competitors. And so interesting, right? Instead of replacing Webdam with the acquirer, Binder, they replaced it with us. And the reason for that is, and you got to think about, just touch on these guys for a second, Funimation and Crunchyroll. Pretty cool anime stuff. If you think about all the movies they have and that they're streaming to their customers, what's happening is they have 80 million subscribers or whatever they have through multiple social media channels and other channels they communicate. And they've got to take, their marketing team has to go into all of the assets that they have, all the movies, and pull snippets out and interesting, cool little branding and logos. It's consistent branding with the overall brand message, and continually make this fresh stuff that then has to get housed in the dam and then shared out to all these 80 million subscribers, right? So it's a pretty cool use case, and to have landed 2 separate customers like that in the year is pretty exciting for us. Particularly as both of those customers, like NBCU, which expanded a couple of times in the year, they went from 320 a year US to 508 a year US with us through 2 expansions in the year. But that's just within the same customer within NBCU. The group has 52 subsidiaries. So, and same with Funimation and Crunchyroll, they have multiple, 50 plus subs as well, but we just need to, earn the right to go and earn their business, right? We ask for their business. So we're working on that. Another one landed in the year was a European one called SVC Services. And they're in the gaming industry. Companies probably no one's heard of. They've got like 30 subsidiaries within that conglomerate as well. That was, we announced it. You'll see an entertainment company in Europe around the September-October timeframe. And it is, I think, in the 90s in terms of value of that deal. So yeah, so there's a little spattering, a little taste. You can see it's across all verticals that I mentioned. And what it all rolls up to now, right? Over 300 customers split around the world. Just why and industry, why? No reason other than we're reaching out to marketing and communications people. Those are our buyers traditionally, and they could be anywhere in the world and in any type of company, and we can support them with an enterprise use case capability that's accessible to all. And as the R&D team continues to build out those features and round out the offering, we're starting to see an uptick in our average contract value as well. So 36% up from 2018 and 13% up from 2019. So 2 years of good expansion in our average customer size. And again, quite a range from 6,000 is our smallest per year to 508. So here we go.
Fantastic. We're numbers guys, so let's dive into some of the numbers, because I was quite impressed. Almost every metric we looked at was a significant improvement over the year. So over the year itself, revenue jumped about 45%. You guys, I think you finished the year just shy of $7.5 million in revenue. Q4, I was actually impressed, not so much, Q4 grew by 26%, but I noticed your operating costs were relatively flat at 3%. Is that kind of what we can anticipate going forward, or do you see another big step up in sort of any kind of CapEx or kind of operating cost improvement or spending that you need to sort of keep growing at that kind of pace?
Excellent, quite way to cut through all the noise to the meat of the issue. Let's touch on, there's a bunch of things that we'll try and keep it as high level as possible. Let's touch on spend. So first things first, we leaned in 2019. And as I said from the slide that I showed earlier, we actually ended the year at run rate cash positive, right? So love it when we can attain that level in the same year. And if we hadn't raised capital, we would have left everything the same. We would spend the same and we'd be cash positive to fund the next leg of growth.
Right.
We raised a bunch of capital, so now we've got an opportunity to invest, and you only do that if you have a large opportunity to uncover, right? So, look, if we can grow this to say 50 million, we're probably spending around 15 million in R&D. The faster we can get R&D up, the faster we can make 50 a reality. Right? Because there's a lot that we just got to deepen that moat and keep adding to that moat, right? And because the market's there, the market opportunity is there. So because we hit cash positive run rate and because we have 16 million of working cap, we'll lean in. Now, when you look specifically at last year, Q4 we actually finally got confirmation from the Canadian government that we were indeed going to receive some CEWS, Canadian Emergency Wage Subsidies. We had some months, obviously, that while we grew, it's great. That revenue growth is coming out of deferred revenue and basically ARR, right? So the reason that it's only 26% in Q4 was because ARR grew slower than it did last year. It's coming from a year of growing 85%, dropping to a year of growing 33%, which gets compounded, right? You'd say, well, shouldn't it have grown better than 26? Then it should be 33. Yes, but it's compounded by the rate of acquisition of new customers. Because when we acquire a new customer, there's 15% of the new deal is upfront fees, which gets recognized in the period. So because we have, then that's why you see here recurring percentage 92 versus 86, right? 94 versus 88, because we had a higher acquisition year in 2019. So a smaller percentage of the revenue was from recurring. Okay. Okay. So we want it to be around 90 or lower, right? Because we want a big acquisition year again. Okay. In any event, and hopefully what we saw, as I mentioned earlier, every quarter we saw some improvement in that. Now, specifically here, the Canadian Emergency Wage Subsidy in Q4, I think it was 600K or so. So we basically spend 3 million if before that. So we did increase, which is what you'd expect, because our plan is, given we have 16 million, to get going, right? And again, just like it's always been for us, the amount that we will spend is determined by how much can we spend and get to cash positive on a reasonable sales assumptions, nothing drastic. How much can we spend and get to cash positive and still have capital in the bank? In other words, make sure we don't need capital. And that's our equation. So this coming year, I will be happy to burn more than we burned in 2020, provided, of course, that the market thesis is still intact and the sales team is continuing to improve.
Okay, yeah.
Right? If that is happening, then I will be happy to spend more because I'll have gotten out ahead and can be working on my moat. So the first place we'll lean deepest is in R&D. Hopefully we can double that this year. It's headcount. So it's hard to add. We'll do it as fast as we can. Sales and marketing, we'll do a good solid increase, but not to the extent of R&D. So, and again, R&D will unlock the opportunity to do another bigger increase in sales a year from now, right? So we're going from 6 salespeople that we had in 2020 to 8 in 2021. So not a huge step up there, but still somewhat. Yeah, so we'll spend more. We had 14 million in the bank. It doesn't earn much there, about 0.6. And if we can unlock and maintain get back to that 55% CAGR through investing, I think that's going to be a lot greater return than what we could get in the bank. So that's really the goal, and that's how we determine what we spend.
Gotcha.
And likewise, by the way, I'll just quickly, we still have, there's debt and IFRS. So you remove the lease liabilities, we had 1 million of debt, right? And so we paid off 2 of the 3 that we had. We renegotiated, got from 7% interest to 6%, and extended the term a bit. We could have paid it off. Obviously, we have the cash, but we kept it there just because it's an extremely good deal. But also, maybe there are some acquisition opportunities to round out our organic growth story, right? And so we'll kick some tires on those, particularly as we add to our bench strength. But that's kind of why we kept a little bit of powder dry, just in case there's some tuck-ins that would make sense that could be part of the future for us.
Oh, perfect. I'm going to remind everybody, if you've got any questions you want me to ask Rob, please use the chat function, and I'll do my best to ask. Why don't we talk a little bit about those sort of the plugins, or let's call them new initiatives. What in the way of new areas you want to get into, and or geographies or industries or whatnot. Let's think of new initiatives. When I ask you that, what new stuff can we look forward to?
Great question. So the first I'm just going to go here. The first thing is, in 2019 or 2020, sorry, 10% of our sales came through referrals through our customers, our partners, right?
Mm-hmm.
So building out our channel partners is a big piece. As I mentioned, 90% is coming from our direct efforts. We want to augment that and build out this channel partner model. What is interesting when we dig a little deeper and what we started tracking in 2020 is when you include the influence deals, we actually had 40% of our deals overall are new business coming through our channel relationships. And what's interesting about that is it mostly speaks to folks like Reich over here. Okay, so they do marketing workflow management, and they have a very good synergistic tie with us, the same customers. And so what we're getting a lot of time is we're having customers come into our pipeline with us as a front runner because they love our relationship with Reich. They love that integration that's already in place. Mm-hmm. So that, I wanted to touch on that because, Insight Partners as an inside sales guy can get between $600 US to $750 US a year in new business, right? We got there in 2019. We want to get back there. Getting to there and even beyond, if you can happen with a really good channel strategy to augment your direct. And so that's why we're leaning in a little more there. And when we go back up to kind of, these integrations, the ones PIM, Aquino here, this is a new one that'll be coming. Content Stack is a new one that'll be coming. We're working on Contentful as well. So we're working on a number of new print UIs, pretty new for us. A bunch of new integrations to go and build that out. And really, at the end of the day, you could think of it as a collective. Adobe has a pretty good story around a complete stack, right? But we can put together a complete stack with good partnerships and then bring lots of synergistic ties with that can maybe even help accelerate that sales team to go up and above and beyond, sort of standard SaaS performance levels, right? By leveraging good partner programs. So leaning in there, watch for us to lean deeper into these top 4 bullets here on our own add-on modules. Creative Spaces is, so just to round this out. So DAM traditionally was finished media. Okay, once you've built it and it's ready, just put it in the DAM, it's memorialized and it's connected to everything then, right? But there's also creative asset management, which is all the work in process assets, right? That's been a different market traditionally, or more accurately, is mostly just lives on the hard drive of the creative guy, right, or gal, right? So Creative Spaces brings all of that work in process media into the overall DAM, ties those two together. Now the creative person actually works effectively within DAM, but and so the company maintains control of all these work in process assets that are used to build the final. Okay, the 30-minute green screen that results in a 30-second commercial. You'll need that green screen again. Don't lose it, right? So we tie that together. Creative Spaces. There's a lot more to go there. We just brought out our remote edition of it in October. That's helping to cross-sell it into existing customers and new as well, because prior to this, you would need a VPN to use it because it's a hybrid on-prem. And so that should help us to go and expand into our customer base with that. There's more to go to the point where Creative Spaces could probably become its own standalone offering, sold separately from our DAM, plugged into other people's DAMs, which would be very interesting because it becomes a Trojan horse at that point, right? So we'll keep building that out. There's a lot more to go there. We'll lean into our advanced AI. Okay, so there's so much to go in artificial intelligence, and we're already ahead of the market, but we want to lean in even more. We see great opportunity to tie AI deeper into how DAM works in really nuanced ways. So probably watch for us. We announced a new customer, a not-for-profit, back in November, a big one, right? 150 a year type account, and we're doing a project with that organization together with Microsoft to leverage UI and AI, and apply it to animals, which AI does a really good job of deciphering between humans because we have so many pictures of the same human, right? But it doesn't do so good with a furry-faced critter. So imagine being able to track the life of a furry-faced critter through wherever it happens to appear in the wild. Yeah. What could you do for science with that? So it's a pretty cool type of project that's underway. You should hear some more about that in terms of how it's progressing in the next couple months. And so leaning in there, and that's nuanced together with Microsoft and going into areas where it's never gone before for AI and DAM. And then audiovisual is an area, another part of DAM, covering both things like we're doing right now, which is enterprise content management, stream video content management. It's streaming type video, and how do we memorialize this and create it, make it available to staff and for promotional purposes using a DAM to hold it and own it. But also your video as well, which traditionally wasn't part of DAM. It was part of media asset management dealing with video. So we're building out all of that so that our DAM actually encompasses the entire DAM equation, from stills to videos to streaming videos to work in process assets, the entire thing, which no other DAM vendor has pulled together. And again, doing all of that at an enterprise class level, but done in a way that's easy to use and removes the complexities of traditional enterprise. And the final is the open API, developing standardized development kits and things so that our customers can truly plug this into areas where we haven't built integrations. And what we want, obviously, is customers to adopt this across their entire organization, all of their key stack of tools, connect through it. The more you do that, the stickier you are, the more you're going to expand and grow with that customer, et cetera. So that's where we're leaning in to build out all of that.
It sort of leans into another question that we just got in the chat board here. How hard is it for a customer to switch a DAM system once they're this ingrained?
Well, I would say back to our goal, which is maturing customers, maybe we'll put it this way, is you want them to use more of your stuff and allow more people to use it. So if a customer has basically, if the user is the marketer and the marketer owns it and the marketer is the interface for the organization, pretty easy for them to leave, right? Because we had one like that, and I remember you guys will recall talking about the Patriots, right? I mean, they had 1 million photos in our DAM. It took them over 6 months to finally exit, right? But they were that type of customer. They were a level, we'd call that a maturity 1 or level 1 customer. Okay, their use case was thin. Okay, so if you have a thin use case customer, they're pretty easy to switch. And when we look at our churn, the average churned value of a customer is about 64% of our overall average customer size. Okay, it's the smaller ones that are likely that thin use case that will churn. And so we got a lot of those out this year. Okay, now what we want to see is our customers maturing with us, and that's why we added customer success, using it, not as bottlenecked in marketing, opening it up. We have unlimited users, let everybody access it. That's the simplest form, right? Then do an integration to help enable that. Integrate with Hootsuite, for example. When you search for media assets within Hootsuite, you're actually searching in the DAM, but you have no idea you've gone to the DAM. So once we start getting some of these integrations and these other add-on modules, we are naturally expanding to a maturity 2, 3, 4, and 5 level, right? And that's where we want to get. Once they get off of maturity 1, then they become stickier with each step up that curve. And maturity 5 is, nobody's at maturity 5 yet. And that would be just like everything's automated and completely seamless and tied in everywhere. But we've got some customers that are, multiple integrations, broad user base accessing it, et cetera. And, that sort of maturity 3 level for us. And those are super sticky, super hard to leave.
So obviously this is a land grab, right? This is relatively new technology, but give us a sense of what your direct sort of total addressable market is. How big does this potentially get with what you currently have? Obviously there's new services and features you can keep adding, but right now with what you have, what do you think you can really address?
So, and it's a good question, because the addressing is not just about product, it's about reach as well, right? So, according to Forrester in 2019, the DAM market for just the solutions, right? There's a broader DAM market that includes the implementation fees and other add-ons and things, and that's a bigger overall DAM market, but when you isolate it to just the technology buy, this is what Forrester says. It's a $1.2 billion industry growing at 33% in 2019. 2020, I don't know if it grew 33%. I doubt it, right? Given COVID, but I think it resumes that path. But that suggests about $300 million a year of additional business happening, which is mostly the greenfield. Plus, there's a 1.2 billion install base that, according to Gartner, organizations, they did a survey of about 400 companies, I believe it was, for organizations with greater than $1 billion in revenue, only 26% were happy with their DAM. So that's your traditional, frustrating, complex enterprise sale, right? So we've got an opportunity to disrupt that as well as the new business coming in, the 300 million, if you will. So lots for us to go get. In order to get it, we've got to have a bigger loudspeaker that's calling out to the market about, so that's both the channel efforts we're doing, that's leaning in on marketing that we're doing, but also we need to have our moat improved. So right now, when we face Adobe, we win 3 and 4. Right, 3 out of 4 we'll win, which is pretty awesome. Yeah. Whereas when we're against a binder or a widen, it's more like we'll win 6 out of 10. Okay. The more we can improve that moat and improve our differentiation, the higher we can get all of them to 3 out of 4. Right, that's kind of the goal, is to, once they come in as a sales qualified opportunity, just continuing to increase the win rate there is the goal, right? So so it's a matter of building the system, improving the moat, improving the use case to make it stickier and be able to enable us to provide more value to the customer. And then, having that loudspeaker continually expanding with our messaging to go and bring those customer opportunities who that'll resonate with to us, right?
Do you ever lose business because you're not sort of as big as Adobe? Like, this could turn out to be pretty mission critical. Do customers look at you and say, okay, you're a little company from up in Vancouver, we're not 100% comfortable, or have you past that status right now?
Yeah, scale and size matters in technology. Absolutely. In every startup goes through it. When you're small, you'll get some luminaries that'll buy your stuff, and that's exciting. But replicating that gets harder and harder as you try to draw more market to you. So yes, size absolutely matters. It's a hard one to measure because people don't necessarily tell you. But and we hear lately, so I know of specific ones where this has happened, and I know where specific vendors have leaned on it, because we're the only public company too. Not only are we maybe a bit smaller, we're the only, obviously Adobe's public, but their DAM is buried in a monster, so nothing, right? Whereas we're the only public DAM that kind of discloses all this information, right? So so sometimes that will be used against you, and I can't tell you how happy I am to have 60 million in working cap that we can lean in and double our R&D investment. That's a huge message to customers, both in our stability and also our commitment to the space. And so it just keeps getting better each time we grow.
Yeah, that's exactly what I was going to sort of lean into, is just that you guys, now you've got much better balance sheet. You should be able to sort of prove yourselves that you've been around for a while and you're gaining momentum. Also reference, you talked about being public, but your share price has doubled over the last year, certainly since we last spoke. You've raised money, you got the investment community that's looking at you significantly differently now. Maybe we talk a little bit about that. Institutional ownership, how does the market kind of look at you now that you're bigger and you've got a little bit more sort of ears under the hood?
Yeah, I think, it's all part of, in order to get a good valuation, obviously we're going to need a good market opportunity that I just think we've proven we have, and an ability to execute against it, which I think we've made good progress on. There's still a long way to go. and you need, a strong enough balance sheet that makes people feel comfortable that you're not going to be out there needing capital, because when that happens, the valuation gets messed up big time. And so, that's our commitment to go and do. And I think that is probably resonating. Obviously, it's a pretty good time in the market right now, valuations wise. But what's interesting to me, and you can see the sort of first of all, obviously 31% inside ownership. I own 7. David owns 7. So we matched up there. The Shen family owns 15%, and a few others own some and stuff. But we're all invested. And institutional investors, Fidelity's dropped down below 10% in their latest report that just came out, which is great to have them kind of at a more comfortable level. We have a few other institutional investors, similar size, that are just under that 10% mark. So pretty happy with where institution is. And that round that we did was 11 of the 11.5 was institutional. So with some big ones, one took 5.5, one took 2.25. It's another at $1 million, and so there's some good size investments in there out of large reputable institutional investors in Canada. So really like how that's coming and the support we're getting there. A long way to go. It's interesting. So what do we got? 11.6 times recurring on the trailing revenue multiple, right? So I kind of look at, this is the KeyBank Capital Markets SaaS survey for 2020. And here's our 11 down here on our last trailing 12 months. And here's our valuation on the consensus, right? Well, geez, it's not even at the 2019 like closing 2019 valuation metric, let alone what's happened this year. So while we shouldn't get this kind of valuation because we're smaller, right? I mean, these are monsters, a lot of them, right? But still the growth rate is there. As we get bigger, maybe we unlock more and more of these, but it also tells me that, it's not a bad place to be right now. So what you saw in the last year is maybe a lot of correcting, as opposed to getting out ahead. Whereas it's not too hard to see, companies like Neat or Docebo trading at 26 times trailing revenue, right? So, and, so I think that I don't feel like we got ourselves overheated. I feel like we're in a pretty healthy spot, relatively.
Yeah. Certainly, a company of sort of your size and stature, good, healthy institutional ownership. Do you guys have any coverage right now?
We have, we do actually. We have 8 Capital,
okay, yep.
And we have Suthan from 8, and we have Gavin from Cormark.
Yeah.
And then PI was covering until David Kwan left, and hopefully we'll pick up the ball again on that at some point. But so our 2 active ones are 8 and Cormark at this point.
Gotcha. Any aspirations to move to NASDAQ?
Well, our first aspiration would be moved to the big board TSX.
TSX, yeah.
Yeah, so we'll, I think we're positioned for that. Hopefully, we can go and do that. So we'll look into that. Then, in terms of the next thing, once that happens, is turning the attention to south of the border, and absolutely over time figuring out the best way to tackle exposure in the US, and whether that's a OTCQX or full NASDAQ, we'll see. But yeah, I think that's something that we take into consideration and long term think about, but short term probably wouldn't be something that would take a huge amount of our time in 2021. But 2021, I think more of like big board efforts toward big board TSX, and then maybe 2022, we're positioned to do something more in the south of the border.
Fair enough. As investors, what should we be watching for over the next sort of 6 to 12 months?
I think just the continued execution and performance, to be frank, right? I mean, you will see us and should watch for us to make improvements, in terms of the net adds and things over the prior year. starting in Q2. Obviously, Q1 has a bit more of a struggle with the large existing customer expansion we had last year, but nonetheless, Q2 that abates, and we should see steps forward each quarter on performance there. And also, hopefully, you'll see us adding to our people, and some news around the type of artificial intelligence and other differentiators that we're leaning into. Should see more news on those through the year as well. But predominantly, it's going to be deal flow and quarterly performance.
Great. Always sort of near the end here, we always like to let you guys have a chance for a parting message or any key takeaway you want everybody to walk away with. So have at it. If there's anything I sort of missed or any key thing you want to say to our listeners, this is your chance.
Well, thank you, Paul, and thanks everybody for attending. Honestly, we really appreciate the opportunity to get in front of folks, and as owners ourselves and deeply invested, it matters equally to us. So your questions are actually very important too, because it helps on how we think about things. But at the end of the day, the main message we wanted to get across, obviously, being, one is that our market is a benefactor long-term from COVID, is by the looks of things, what Gardner says, that's what the large organizations that were able to invest in the down cycle said. And, that's what we're leaning into. We think there's a great market opportunity, and, that hopefully what's conveyed is that we're methodically and pragmatically, investing in growing and tackling that opportunity. This year, again, getting the chance to do a step increase, just know that is being done because we see that opportunity coming out of COVID is extremely strong, and we want to get out ahead and earn a lion's share of this market as it continues to grow. So, great opportunity. I hope that it was conveyed clearly, and that we have the capital and the inertia to go and tackle it. So those are the key things for us to get across.
Fantastic. Listen, 2020 was a trying year for a lot of companies. You guys managed to grow your business, and you've been growing it nicely for a number of years. So you guys weathered the storm quite well, and looks like everything's set for continued success. So congratulations on a very strong year. I personally want to thank you. This few times that we've managed to catch up and get an update for our subscribers. So that's great. I really appreciate it, Rob. Everyone, we've been speaking to Rob Chase, Chairman of MediaValet, MVP on the Venture Exchange. As always, Rob, great to have you here, and looking forward to the next update.
Sounds good. Thank you, folks. Have a great afternoon.